So the group closed the year with a profit after tax of 74.9 billion, representing a 4% year-on-year growth. This performance was supported by a growth in operating income of 16%, driven by both funded and non-funded revenue streams. Growth in total income was supported by net interest income generated from lending and investment activity across both the private and government sectors. During 2025, the group recorded strong growth in both its retail and corporate sectors, particularly within the sectors that we are actually focusing on, as mentioned in the strategy update. Non-funded income grew by 24% year-on-year, driven by higher fees and commissions resulting from increased customer transactability, supported by improved stability of our digital platforms. Further contributing to revenue growth was increased trade finance, foreign exchange business, and rental income. On the balance sheet side, the group continued to strengthen its balance sheet position with a growth in total assets of 8% year-on-year, closing at 3.7 trillion Uganda shillings. Loans and advances to customers increased by 12% to 1.265 trillion, reflecting continued private sector credit growth. Government securities increased by 3% to 1.32 trillion, with a concentration on short-dated instruments to maintain both liquidity and optimize yields. Customer deposits grew by 15% to 2.71 trillion, supported by deeper customer relationships, acquisitions of new-to-bank customers, and successful customer reactivation initiatives. The next slide will look at the key performance indicators. We'll start with asset quality. The non-performing ratio improved significantly from 2023, where we had 9.5, down to 6.4% in 2025. This reflects strengthened credit monitoring and recovery processes. We did have a slight increase between 2024 and 2025, but this was primarily driven by a small number of large concentrated exposures. So our focus for 2026 was to rehabilitate these loans, and this ratio later dropped to below our internal limit of 5% by end of half year. The credit loss ratio closed at 0.8%, below the industry average of 3%, indicating a well-collateralized loan portfolio and effective credit risk management. Under earnings and returns, our return on average equity remained stable at 10% in both 2025 and 2024, compared to 4% in 2023, which reflects higher earnings and improved returns to our shareholders. Return on average assets remained steady at 2% in 2025 and 2024, from 1% in 2023, demonstrating improved asset utilization and earnings generation. Under liquidity, the group maintained a very strong liquidity position, with the liquidity asset ratio closing at 45.2%, compared to 34% in 2024 and 39% in 2023. This provides sufficient capacity for the group to be able to meet its short-term obligations, as well as have the ability to absorb any potential liquidity shocks during any period of stress.